Right, to illustrate the idea that losing is not necessarily a bad thing and that being right first time is often much harder to do, we're going to use a pretty old example, something called the Monty Hall problem. Now, many of you may well have heard about this. What it serves to do is to illustrate that new additional information improves the probability of you making a correct choice in the future. For those of you who don't know the problem, brief explanation. This is a game show, and at the start of the show, you are offered the chance of picking one of three doors. Now, behind the doors, as you can see, is a car, a goat, and a goat. So you have a 33% chance of winning the car. Now, once you have made your choice, the host will open one of the doors at random. Now, of course, you may well win the car. But let's say, for example, you have chosen number 2. And the host opens door 3, revealing a goat. You are now offered the chance to change your mind. Should you stick with number 2, that was your original choice, or now knowing that there's a goat behind number 3, should you change to number 1? I'll leave you guys a moment to think about that. So pause the video, have a little think about whether you should or shouldn't shift. And then we'll get the answer. Now, the answer comes down to additional information gained. If you think about this, to start with, the chance of you picking the car is 33%. The chance of the car being, or of you being wrong, is 66%. So you've got a 66% chance of being wrong. Now, if you change, so let's say you picked number 2, your chance of being wrong in this situation is 66%. Given the fact that you now know where the goat is, this guarantees that it is not there. So in fact now, your chance of being wrong by staying is 66%. Your chance of being right by moving goes up. Because of the potential wrong decisions, these two at the beginning, so at the beginning, your chance is 33% of winning the car. Now, you have a situation where you have a 66% chance of the car being here or here. You know that it's not there, so there's now a 66% chance that the car is there. You have improved your odds, you have improved the quality of your decision based on additional information incoming. Perhaps not the most succinct explanation of it, but as a way to think about this and makes this a much easier problem to solve, imagine if you had 100 doors. You pick a door to win a car. Your chance of being right is 1%. Now, if you are shown that there is a goat behind 98 of all the other doors, is it logical to stay with your 1% chance of being right, where now you've been shown that it's definitely not in any of the other doors? Your chance of being right by moving has now gone up dramatically. It's much clearer when you think about it in that sense. The point here being that as information changes, the probability of you making a right decision improves because you can then use that information to deduce more. This is the idea of Bayes' theorem. I'll let you guys go and have a little read on that yourself. But the idea of Bayes' theorem is quite simply that you have a certain amount of information which gives you an ability to assign a probability of something happening, even if it is not as simple as 3 doors, in which case the probabilities are well defined. But you can assign a probability of something happening. As information comes in, that probability can be adjusted by virtue of the new available information. I'll illustrate that in just a moment. So, remember, chance of being right first time is generally lower than when you have more and more information. It may well illustrate to you the more information that your chance of being right from now on is much lower, in which case you don't take the trade anymore. But if the information suggests that the trade is more likely to work now, or that extra information improves the quality of trade, that's where you want to be taking that trade on. So, how to define the quality of a trade? This is all about expected value. Again, for any of you who have played games like poker, games of chance, expected value is a key element of it. What expected value does is it takes into account, 1, the payout, but also the probability of the win. So it's not just looking at risk reward, which is the value of the win versus the value of the loss, but it's the probability of getting that win versus the probability of taking the loss. Now, this is not something, when we're talking about probabilities here, that you are defining from backtesting and saying this has an X probability chance of winning. You are looking at the situation available right now and asking, is this a likely thing to happen? So essentially, your assigned probability is based on your conviction on a trade, if you will. That's the way to try and think about this. If you take, for example, a sports match, game between two, let's call it tennis players, you can look at historical performance in matches between the two and say that statistically one player is likely to win. But if you watch a lot of tennis, your experience can tell you that perhaps one player is more on form, that in fact, whilst the statistics say one thing, the information you have available at this point in time based on their current form tells you a different story. And this then further continues throughout the game. As one player wins the first set, now the probability of them winning that match starts to change. So you're not then just basing it purely on historical probability, you're basing it on probability based on the information available at the moment and the changing information that becomes available. So we're going to go and have a look at a trade example here. Now, there's two trades to be looking at, and just before we get into that, just a clarification of what exactly expected value is and the way to calculate it. Expected value is the probability of win times by the value of the win, minus the probability of a loss times by the value of the loss. Anything with an expected value above 1, theoretically, is showing an edge. What I've done here is converted that expected value into ticks, so the number of ticks that you will achieve over time. In terms of expected value, these would be 1.52 and 1.26 over time. We've converted that to ticks to make it more appropriate, a way to kind of judge this trade over the longer period of time. So, trade 1. You're looking at a potential win of 32 ticks with a risk of 10. Your risk reward is quite clear, 3.2. Your estimated probability, this is your perceived probability of this trade working, is 60%. Therefore, you have an expected value of 15, i.e. if you took this trade multiple times, you would achieve 15 ticks on average across all trades. So if you took this trade 10 times, you would lose 4 of them, you would still make 15 ticks for every one trade. So over 10 trades, you're going to make 150 ticks on this trade, or 152 ticks to be precise on this trade, including the ones that you lose. So that gives you a realistic judgment of the value of this trade over time. Now, trade 2, smaller win, smaller loss. Marginally better, but roughly the same risk reward ratio, much higher probability of working, expected value essentially is slightly less. But where trade 2 has an extra additional sort of kick, if you will, is that when you're thinking about the reality of executing this trade, yes, the expected value may be slightly lower, but you're achieving this when you're only able to achieve 17 in total anyway. So the relative expected ticks to potential is much tighter. That's a symptom of the probability. But also, from a monetary perspective, if you're only risking 5 ticks here, you can take the same monetary risk with double the size, because previously you're willing to take a risk of 10 ticks. So you can take the same monetary risk, double the size, but with a much higher probability of the trade actually working. So this comes back to Bayes' theorem, that as more information becomes available, the probability of something happening can change, and if it changes favourably, this again is a reason to take more risk on. These two trades are actually part of the same move, and so by understanding how probabilities are changing, what it also means is that trade 2, if you're already in trade 1, is a justification to add to your trade. And this is one way to try and add to a trade. It's looking at a situation saying everything's improving now. Don't then take that as a reason to sit back. When the odds of your trade working increase your size. By doing this, what you're doing is you're maximizing the probability of something working when it's already showing you that it is. For those who play poker, other games like that, and have a rough understanding of gambling strategies, One of the ways, for example, in horse racing that people will bet is that as the odds get shorter, for most of us, you bet on a horse at 10 to 1, you think, great, I'm going to make 10 times my money. But as the odds get lower and lower, they come in to 6 to 5 to 3 to 2 to evens, professionals are going to bet more because the odds are telling you that this horse, based on information that is becoming available, however that's becoming available, and people's perceptions of that happening, is becoming more and more likely to win. And so therefore they will bet more money because the information available now is clearly greater than the information available before, and that's improving the probability of your win. That's a reason to leverage your trade up. So make sure you're thinking about that and your risk adjustment and the ability to add on. Think about the probabilities of a trade working as opposed to just purely risk reward. Right then, let's go and have a look at the trade. This is the trade that we're looking at. Now, this is the beginning of the situation, and so this is trade one. The idea of trade one is that you're going to sell on the pullback to this high. So you're going to sell at 39 with a stop above the VWAP at 49. There's your 10 tick stop. Your target on this trade then is down towards 07, which is the VPOC from the previous day, or sorry, from 2 days back. So that's your target, 32 ticks. At this point in time, this could be a rejection and a reversal. It could be a pullback and we go. There are multiple things that could happen, hence why the probability 60% of this trade actually working, but you're going to get a decent payout on it. Now, that's trade one. Trade two is here. We've gone from this point, we're pulling back up just here. Now, we have done that pullback, just missed the stop on the trade, and are now falling back down. So now you have more information. This is now a market that has not managed to get back up into the previous day's value, has confirmed the single prints, has held the VWAP, and fallen back down. Now we have a situation where you have a new breakout trade to play down. This is the 80% trade. Why? The reason for assigning 80% is a judgment that if this little range breaks to the downside, there is almost nothing to stop you reaching the low. And once you reach the low of the day, you can then look to reach the previous VPOC, the VPOC of this little range here, just down here. So that becomes a much more viable trade, hence the 80%. What this is showing you is that if you took this trade on and sold it there, rather than thinking, oh, this has been uncomfortable, thank goodness I'm back on side, you should actually be looking at it saying, well, I'm now more right than I've ever been on this trade. I need to add to this. And a good way to always think about that is ask yourself the question, if you had no position, would you take this trade? The answer, I would hope, is unequivocally yes. So in that case, if you've already got a position, would you take this trade? The answer has to be yes. And that's the way to try and think about it. You want to have yourself, and by using expected value, by making a judgment on a trade in this way, you put yourself in a position where you ideally can look at a trade and be able to say to yourself, I have no excuse to not take this. I have to take this trade because everything is saying this is the right trade to take at this point in time. That's the way to use expected value. Right. The other part of expected value is how to look at a trade from a probabilistic point of view. Again, assign probabilities based on current information, not back-tested probabilities. And what you can then do is also understand where the probability of something happening is going to rapidly increase, because that's the time to leverage up as well. So let's have a look at this from a probability perspective. What we've seen so far on this day, this is a trade. We've had a sell-off, a balance with a close at the top. Daily candle wise, this is very clearly a hammer type candle with a very small wick at the top. So you've got a very bullish looking candle from the daily. You have a neutral extreme profile. You open above value, trade down, fail to get inside value, and are now trading higher. So everything is tipping in favor of a move higher already. This is where you're trading. So what can happen from here? Well, we could trade up the range, up towards single prints, top of value. So around about 13 to 33. That's viable. We could also continue to balance this out in here. That currently is what the market is doing, balancing out. So you can assign some probabilities here. The chance of the market going up towards 17 and then beyond is about 60% whilst you're trading in this range. Now, if you break the high of the day, you could very confidently say the chance of it going now has jumped significantly. And so you can have this planned out that at this point, you may not want to enter the trade. Certainly you can look at this and say to yourself, well, I don't want to be entering at the top of the range because I'm now taking a relatively big stop of around about 20 ticks for a move of around about 25 ticks with only a 60% probability of it working. Whereas once you break 02, get out of the range, now your chance of this working goes up dramatically. This is the point where risk can be minimized and the payout is very clear and very high probability. So it's not just a case of probabilities, but also understanding how your risk reward shifts. This point, your risk reward jumps in terms of the payout compared to risk is very, very high, and the probability of you getting that right is also very, very high. So this is what you would call an asymmetric trade. Everything skews in the right direction. Risk reward skews in your favor. Probabilities of the trade working skew in your favor. This is the point to take on more risk. And it's something that people don't think about, and it's something that one of the top traders is really good at, and sort of brought this concept that there are places to take risk. And at this point, you should be taking as much risk as you can because the cost of being wrong is very low, the payout of being right is very high, and the probability of being right is also high. So when those things all match together, this is where you should be maximizing the amount of risk that you're taking on. Take the situation then. We break 02 and the market sits relatively still here. It doesn't explode towards the upside, and this is not a particularly high volatility period. But you can now define your risk very clearly. If we fall back below the previous high, or even if you want a secondary high down here, it's around 96. So you've got about a 6-tick risk on this trade. You've got now at least an 80% probability that we're going up here, and then potentially all the way to fill value in. So you've got a very high probability of it working, a very small risk relative to your payout. This is where you should be looking at this trade and saying to yourself, anywhere in this box is an ideal place to take on risk. And trying to build your position up as much as possible here, because the odds are stacking in your favor. That's how you want to be using expected value, probabilities, to define whether you should be taking risk on or not. And note, I'm talking about this from the point of view of taking more risk on. It's not about minimizing your risk here. Of course, this is a cheap trade. You could take that on, not feel a great deal of pain if the trade goes wrong. But don't do that when the opportunity is extremely high, because you're getting this one chance to really maximize this opportunity. And by doing that, what it gives you is large growth towards the upside, meaning that the next time you take a loser, the impact of that is much, much less. Right, speaking of impact and taking losses, taking winners out of trades, leveraging positions. Intraday P&L management. What's really important is the sequence of your performance doesn't matter. I know a lot of people focus on, right, get the first trade right, and then you're going to just onwards towards the upside in terms of your performance. That's not necessarily the case. The sequence doesn't matter. So don't change the way that you trade, at least within defined boundaries. People are often too quick the moment they start to lose a bit of money to decide, right, reduce size down until you inch your way back and then increase size again to try and get up. The problem with that strategy is that what can end up happening, let's say you only have a certain number of trades in a day, there's not going to be constant opportunities. If you lose on the first couple of trades and go down, you then may need the next 4 or 5 trades because you're doing it on smaller size to get back up, meaning that you've got very few trades that now must go right to be able to achieve a good day. This is what I mean about the sequence of action. So by having boundaries within the day, for example, the orange line be in a boundary where you do not change size and you do not change the way that you trade. This allows you then to grow your performance throughout the day. Once you fall below the boundary, then absolutely reduce your size, reduce the risk per trade, because the objective at this point now is to get yourself back to a position where you can start to take risk on again. Get yourself to a position where you give yourself a chance to get back. So absolutely there needs to be a point where you reduce your size. Once you're back though, within this boundary, put your risk back to normal. Take trades on in exactly the same way as if you were up or down. And so if you take this to be your boundaries where risk doesn't change, after that to the upside, so let's also focus on the upside here, trailing stops. You can then start to raise your trailing stop. Raising a trailing stop, don't keep this linear to the amount that it started with. So let's say, for example, that you have a stop at the beginning of the day, flat to stop is $1,000, pounds, whatever it is. What you don't want to do is go rushing to keep that stop exactly the same as your performance for the day goes up. Once you have passed an average good day, then you can move your stop up and perhaps move this up to flat. So you know that once you've achieved at least an average good day, you are not going to give any more of that away. The last thing you want is to get a decent performance and then give it all up. Psychologically, that's painful, but you need to give yourself space to still be able to take risk on, to push on. That way, you've got your goal of reaching your best day and the ability then to take sufficient risk to get there. Once you're above here, I would argue that then this is a boundary to now start to reduce size. So you can reduce size below the orange line and then reduce size above the purple line to consolidate having your best day, or best day for that situation. What you don't want to do is get just above an average day and then start to rein it back. The idea then is to move your stop up, which protects you, and then once you get over your best day, then you can raise your stop slightly further and also reduce risk per trade. This way, you maximize opportunity, you take advantage of having that larger P&L on the day. So effectively what you're doing is you're trading your current P&L. You're using that to give yourself the leeway to go onwards. And yes, of course, you could see this come back. You could end up not taking such a great day and just an average type day. But by giving yourself that space to take on more risk, because you've earned it by earning more money on the day, you now give yourself the chance potentially to double this. You don't know what's coming for the rest of the day. You don't know when what potentially is a very good day could turn into an exceptional day. And by giving yourself the risk and the space to do that, you allow that growth if the opportunity comes. Now, there's something else that I think is really important. I see this with so many traders. What I call cliff edges. What a cliff edge is, and this is something that you can work out for yourself. A cliff edge is a point where, as your day goes down in performance, so let's say, for example, the orange line away from what we were just previously talking about is your cliff edge. For a lot of traders, they will have this point where they say, okay, my stop is, let's say it's 1,000. My stop's 1,000 on the day. But they will have a cliff edge at 700. What happens then is that as soon as they reach 700, you can be very confident, and I see this looking at the risk, that they're going to 1,000 anyway. So essentially, if you hit 700 down, you're going to lose 300 more, because people lose their heads, they go and shoot for trades that may not have any viability to them, or they're taking on hope trades. And we'll talk about this when we look at psychology and the kind of risk weighting that people put on trades. People take on trades that are less viable when they're down in the hope of recouping it, because it's the prospect of what they can achieve that entices the trade. So understanding where your cliff edge is helps in defining really where your stop should be. Certainly, if it's not going to be the absolute stop for the day, it must be the point where you significantly reduce size. The way to work this out is to look at your performances when you've gone down and come back to green. So how far down have you managed to go and recover? Because that will help you define whether there is a point that, the point of no return, essentially, that if you pass that, you're going to get stopped out. That's the thing to be aware of. That's the thing to be looking for. So go and look at that yourself. Look at your previous performances to work that piece of information out. So that's how I'd consider managing your P&L throughout the day. Don't focus on getting the first trade right and building from there. Focus on having a range in which you're going to continue to look for the bigger opportunities, continue to look to push on. And once you're outside of that range, then you can start to try and hold back and minimize. Equally, when you're down, don't rush to just reduce size to a point that it's going to be very difficult to get back out of. If you go down and it takes you all day to get back to flat, because you're doing it with very, very small size, you don't give yourself many opportunities left. And if you then re-increase size here and the next trade goes wrong, you're not going to get it back because you simply won't have enough time or opportunities in order to do so. So have that boundary, have that range in which you're not going to change and you're not going to adjust your performance. What this comes down to, and the psychological side of it, is what we call endowment effect. And this is a variation of loss aversion and something that you need to be very aware of when you're taking trades on. Take a trade for what it is. Now, it's easy to say that, but the more aware you are of this impact, the more you can kind of look at a trade and go, no, I'm taking the trade for what it is. So, the idea of endowment effect is that once you own something, losing that is much more psychologically painful than not owning it. So if you never owned it, not owning it is not as bad as if you owned it and you've lost it or you had to sell it. So essentially, people put a much higher value on something they own. Take, for example, and this was an experiment done whereby half a class of students, I think this was done on multiple classes, half a class of students were given a mug that you could buy. So they could buy it and they know the price of the mug. Half of them are given it and half of them aren't. So they've got a free mug. And then they're all asked to assign a price. The price for those who have the mug of them selling it, what price would they sell it for? And for those who don't, what price would they buy it for? As you can see, the difference is quite distinct. For a $5 mug, £2.87 for those who don't have it, that's the price they would pay for it. Theoretically, they don't have one because they're not willing to pay $5, so they're clearly going to pay less. And for those who do now have it, despite the fact they paid nothing for it, they now want £7.12 on average, despite the fact that surely anything above the retail price of it, or indeed anything above zero, is worth selling because they didn't have it in the past. What this basically shows you is that for a trading perspective, the P&L you have on the day, you try and protect. Now, the way to think about this is that your P&L on the day is tradable. Until your money is in your personal bank account, you have to view this as a tradable business account, if you will, in the same way that any other business would do so. The difference with trading and traditional businesses, if you will, is that in trading, what you do is you take your money, you buy something, and you try and get more money back for it. A traditional business will take their money, go and buy an item. So let's take a shoe shop as an example. This one taken from a book. Yeah, there's many other different examples, but this example that I was reading. Shoe shop owner. What they do is they go out and they buy shoes from a wholesaler. They then put a markup on the shoes. So that's their value add. And they're doing this because they provide a good service. They're a shop where you can buy them from and you want one pair, not 100 pairs. So they can charge a higher price. That's their profit. But what they don't do then is once they've got those shoes, say, oh, but actually the value of these shoes is 6,000 because they could sell them at £60 a pair rather than 50. But actually I'm going to put the price at 80. so that I can protect the value of the shoes, because that way I don't have to lose them. You have to view them as tradable. Now, when they're personally owned things, you might place a higher value on it, irrespective of what the real value is. There are certain things that I own that I will not sell for what the real market value is. That's a protection thing. That means I will not have to sell them. And that's what people do with their P&L on the day. They increase their P&L, they now see this as owned, and by not taking on any more trades, what you're doing is you're effectively putting a high price on the money you have that prevents you from losing it. But whilst preventing you from losing it, you've just guaranteed you can't make any more money on it. You have to look at the money you have on the day, the money you have in your trading account, as tradable assets. And if you look at it like that, you can look at the next trade and say, you know what, this is a viable opportunity, I can trade it and use my tradable assets to turn them into more money. Of course, you may not be able to turn them into more money and you may lose money, in the same way that a shoe shop owner may not be able to sell those shoes for 60, and in which case they take the loss. But they view these assets as tradable, and that's the way you have to view the money in your trading account. It is a tradable asset until it moves into your bank account, in which case it's for you to do whatever you want to do with it. And so that's the whole concept of what I was showing previously, that if you start the day at 0, you have 0 minus X, to which point you do not change your risk, and you have 0 plus Y, to which point you do not change the amount of risk you're willing to take on a trade. Once you're beyond these points, there is a reason to reduce risk, particularly on the upside, as much as the downside. Downside, you're reducing risk to make sure that you don't create an excessive loss, and you have to have a final limit, a final stop. Upside, whilst theoretically you should not reduce your risk, and we'll talk about this in psychology, there becomes a balance between the additional performance gained versus the psychological impact of losing. So it acknowledges the endowment effect, but you have to create parameters around that. Once you perhaps topped your best day, and you can have best days for different things, you know, best day on news, best day on a purely technical play, any of those things, then you can reduce the size down. Again, because the psychological impact is felt greater if you lose something you've already got. So yes, theoretically, it is entirely tradable, but let's be realistic about it as well. And make it entirely tradable to a point, and beyond that, then you give yourself that leeway to reduce down. What that will also do is we'll push this point out. That's the goal. You should then push that point out when you go beyond it and reduce down, so that next time this is your new benchmark, and then you keep pushing it out. So this keeps growing. That's the way to try and think about it. Of course, your total risk will grow slightly at the same time, but that's the way to try and deal with endowment effect. Right, final thing then. We looked at managing P&L throughout the day. Finally, account management. Now, this is a generalized accumulated view of numerous people's account management. This is not to say this is how to do it and this is the amount of risk that you should or should not take on. Just want to be clear on that from a regulatory perspective. What you have to remember, and this is really important, is that your account growth in the early stages of your career can be much more significant. And that the potential loss on any day as a percentage of your account equally can be much more significant. The way to kind of think about this is like a startup business. When you start up a business, the size of risk that you may take on early ventures relative to the total company's capital or value is very large. Now, you're not going to have companies like Amazon, for example, risking half their company's value or half their company's assets on the next thing. Because they don't need to, because they can use a tiny fraction of the company's value. Because the company's value is high, they can use a tiny fraction of that to be able to still achieve a new product. So early on, one of the things to be aware of is that you may well be risking 10% plus on a daily basis, if not more, dependent upon the size of starting your account. And that is something that you have to accept. Trying to minimize the percentage risk down and using, you know, a standard kind of investment portfolio strategy of 1 to 2% risk per trade runs the bigger risk that you do not have enough leeway to trade. So you give yourself such a small risk on the day that you almost can't take trades on because the amount of risk you've got to take is too small to deal with that. That's where the problem lies. So you have to accept you're going to take a bigger swing early on in your career, percentage-wise. But also bear in mind, because futures are leveraged, your chance of creating a 100% account gain in a day is reasonably viable. If you start with a $2,000, $5,000 account, you could make 5,000 in a day in certain situations. It's much harder to be able to do the same thing when your account is much, much larger. And one of the other reasons for that is what you call an edge gap. Traders early on in their career have so many different ways in which they can improve. The scope of improvement is much bigger, meaning that the scope to jump in performance relative to what you're used to or what you've currently got is huge. As time goes by, to maintain that same momentum of growth is extremely difficult. And also, to maintain that level of growth requires so much more capital. If you're increasing performance 10%, 10%, 10% per month, very quickly you get to a point where the amount of capital required and the amount of risk you have to take to achieve another 10% gets exponentially more and more difficult to do. Your skill set doesn't grow that quickly. So you now need to just be taking more risk to achieve that same level of growth going onwards. Now, the reality of how your performance will change over time. Once you've got to a larger account, 100 grand plus, this is where you can be a little bit more strict and a little bit more rigid in how you manage your risk. And percentages can be applied a little bit more. Now, the way that most people will do this is to have an absolute maximum daily risk of 10%. So it's still very high maximum daily risk. So let's say you've got a 100 grand account, that would imply max daily risk of 10,000. This may not be standard for you. You may rarely ever lose more than 2,000. But if you have a theoretical max of 10,000, what this can allow you to do is also define your maximum size. And the way that people will define their maximum size, maximum number of contracts they can trade, is by saying, right, if I went full size in whatever market it is, could I lose 10% of my account on a normal type loss? Not looking at something wild and you end up losing 200 points or 2 big points in the S&P on a trade. You're unlikely to do that. So what would typically you be able to lose, or what would a typical size loss be? And if you did that with full size, would that stay within 10% of your trading account? If so, your size can be appropriate to that. So that's how people will look at their size. By doing this, it allows you to grow your size. It also means that realistically you're not going to hit a 10% drawdown, but you have the capacity. And what it also means then is you have the capacity to generate still these types of gains towards the upside. Someone with a $100,000 account, to generate a $10,000 gain in a day is entirely realistic and is entirely viable. And so that's the way that you have to think about that. That by looking at your size in those terms, you give yourself that scope to be able to achieve those bigger days. Now, when it comes to increasing size, one of the things that is so consistent is this type of pattern when people increase size. That what they will do is their performance goes up, so this is your equity. Equity rises, they then start to increase their size. Now, when size increases, typically traders will go through a pattern of this sideways performance in their equity. And this is down to getting used to trading that larger amount of size. You are going to take bigger losses. You're going to take bigger winners. But the comfort in that is not necessarily there straight away. And so you get this swing in performance. One way to manage this is to say to yourself, right, I have earned X amount. I'm going to give myself X amount of dollars risk here. i.e. I will allow my equity to fall by a certain amount in order to learn to increase my size. By doing that, you allow yourself to weather this storm, if you will, And if you are still applying your trades in exactly the same way that you previously were, there is no reason why you won't, once you're used to that size, be able to grow again. So you will get past it. If you find that you struggle, then this is an indication that maybe you've stepped a bit far at this point in time. You can reduce back down, you can get back on the upswing, and maybe you end up then seeing your performance sort of wiggle like this, and then wiggle again before then another go. So a kind of false start. That's fine as well. But just be aware that that is quite typical. Now, one of the things to justify increasing size is your consistency in your application of process, not equity. Because if you look at your equity curve, some big event happens, a couple of trades that you really like go just right, one after another, you get a big jump. Now, this hasn't suddenly made you a better trader and somebody who can now take more risk. What it has done is illustrated the law of small numbers, that you have hit an extreme situation where you've had a few things go exactly right for you at this point in time. When that happens, that's fine. Take a step back, say to yourself, right, that's good. If I can maintain this consistent process now, then I can increase my size. One of the other things to do as well is when you feel like you're applying your process consistently, increase size more aggressively. Don't sit there and go 1 lot, 2 lot, 3 lot, 4 lot, 5 lot. Put in bigger jumps. By putting in bigger jumps in P&L, in size traded, what you do is you force yourself out of your comfort zone. Because by adding the same amount each time, the percentage growth in the risk taken is smaller and smaller and smaller over time. So by adding bigger increments of size growth, you push yourself out of your comfort zone. You force yourself to look at the risk that you're taking, and you force yourself to be more selective. Part of the difficulty after a while is that you become so comfortable with trades that you don't feel any kind of pressure or pain on a trade. And when you get that, that's a good sign to increase size as well. So there's not a defined this is when, or when equity grows by X, you should increase size. It's more judged on the consistency of your performance. If you're consistently following your process and you're consistently seeing results on the back of that, steady equity growth, then increase your size. Accept that you will see this. But by increasing the size, you give yourself that sideways action before then the jump. And that's then the next boost, is the big step up. That's how to go about doing it. Otherwise, you get stuck very slowly increasing size. Now, the difficulty with very slowly increasing size is that if things start to change and you have only very gradually increased, then when things change, you start losing on the biggest size that you've had. Whereas if you increase size more rapidly, yes, you lose on the biggest size you've had, but the run-up has been so much greater. So by increasing size more rapidly, you give yourself a much greater swing up, meaning that when you do get impacted by losses, which are inevitable, these will have a lesser impact on you and pull you back less. So there we have it. Risk management in a nutshell. We will be discussing this more in the live sessions as well, and looking at how people have applied risk management throughout the day. Look at some traders' different kind of risk profiles and the way that they look at different trades. So we'll be doing that, answering any other questions on this coming up.